I just think that in this new market reality, our approach, Aretec's approach, really lends well to that and is really built to thrive in this sort of environment. And we've seen that play out in 2025, 2026, and for quite some time. This is the Realize Your Wealth podcast by Aretec Wealth. We want you to be wealthy. We want you to feel wealthy. We want you to realize your wealth. All right, here we go. We're back. It's Friday. It's cold out there. We're still in a deep freeze. We've been digging our way out from the snowstorm all week. Greg's back from his vacation. He's back in the saddle here. But how you doing, Greg? How was your trip?
Yeah, it was good. It was awesome. Weather was nice. And I was making the joke, I've never been as happy to come back to minus 30-degree snowstorm weather, just because we were at the airport and flights were getting canceled and we were worried that our flight wasn't going to make it home. And, the Dominican airport is the last place we want to be with a little baby. So happy to have made it home, and it's okay that I'm back to the cold. No complaints.
Nice weather, but no, happy to have you back. Roman had a strong debut last week, which was awesome. He was tackling some tricky topics, but we got more news, more events, more kinds of craziness to unpack this week. But it's definitely a little bit of a choppier week in markets this week for a host of reasons, or it almost seems like every week now is getting choppier. But definitely a little bit of a down week or an off week in markets, at least as we look at this on Friday morning. But lots to unpack, even as we were going through the topics for this morning. Then we get the announcement there's a new Fed chair coming, and we're rewriting the script here and the topics. So we got to unpack that. We got to be ready for anything in this world, this environment.
Yeah, we were scratching out topics from earlier this week, writing down new ones. So yeah, markets have been kind of mixed sideways. I mean, they're maybe a little bit softer today. We've seen some volatility kind of both to the upside and to the downside with gold, which is correlated with our portfolio. But kind of the big news, which is moving markets to a degree, is that Trump has nominated a new Fed chair, Kevin Warsh. Obviously, a lot remains to be unseen, but what are your kind of initial thoughts on that?
I mean, the market seems a little bit negative on it so far, at least as we're looking at how the news is digested. But I mean, it's still early. This came out maybe 7 a.m. this morning, and it's about 10 a.m. now. So markets are just opening up, starting to digest it. But I think the quick take on it is it's kind of interesting because potentially the new Fed chair, or at least the nominated Fed chair, is more hawkish, which means more likely to bring rates up, when all of the talk was about interest rates going down, interest rates going to zero or COVID levels or negative levels like we've seen in Japan, because the Fed chair is going to be Trump's puppet. And then for whatever reason, he's nominated someone that is more hawkish. I mean, I certainly think he's in Trump's camp and on Trump's side, and the talk is that he's more dovish, but I think it just market-wise maybe introduces a little bit uncertainty, because it's does that mean rates are going to actually go up? I think what I'm hearing so far is that there could be some contention about even his nomination. Is that going to go through? Is he going to be able to? Are they be able to get things done? So I think that the tone right now, though, is that it's just more uncertainty. This could be a little bit more hawkish. You're now seeing that ripple through into things like gold and the U.S. dollar, which had been gold strengthening, U.S. dollar weakening. Now that's flipping back today, which ties in with interest rates. So gets into just this whole new world order, new market order, just all kinds of chaos, craziness, uncertainty, which will move markets all the time and shift and change things, which if nothing else keeps us on our toes and keeps things interesting.
Yeah, the one kind of good piece that I'm taking from this, and obviously we'll still have to unpack it more, is that he seems to your point, historically be a little bit more hawkish. And I think that will just kind of ease investors' mind, knowing that, I think he's going to remain kind of independent. He kind of is going to be data driven and not just necessarily, be a puppet for Trump. So I think that can bring some good news for investors.
Yeah, we'll see. I think that's what the market wants is they want stability, they want independence out of the central bank. So it's certainly better than Trump nominating himself as the chairman of the Federal Reserve. I think that's a win, but at time will tell. Like we will watch the markets and listen to the markets and see what investors are saying about this and digest that over time. But right now, I think the market's reaction is a little bit mixed to this.
Yeah, no, 100%. And Will, you kind of mentioned this earlier. Like basically, since the U.S. election in 2024, we're really into like a new market, kind of like a new market order, if you will, for last kind of year and change or so. So with that and what we're seeing right now, maybe just give us a sense on what's kind of winning and leading the market, but what's also cruising and going against the grain.
Yeah, and I think we've seen that as portfolio managers, as investors. I mean, I think clients just see that, investors see that, just watching the news and seeing what's going on out there in the world. That it's a new reality, a new world that we're living in. It's just a different environment to be investing in than maybe we saw for the last few years. And there's all kinds of different drivers and different factors to consider. So it really is a new order, new reality that we're dealing with in the markets. And there's some winners for sure. There's some losers. What we've worked to do for clients is try to position them, with our research, our technical analysis, position them on the right side of that. But it's diverse. It's changing. I think it's an environment too where there's just enhanced volatility and ups and downs. Sometimes that volatility is to the upside actually, and things are shooting up based on news and social media and all this stuff, and also to the downside. But yeah, we'll get into that a little bit. Winners, losers, get into some of the specifics as we go here.
Yeah, but one of the biggest winners we got to mention has obviously been gold, and well, I'll give you all the credit in commodities because right after the U.S. election in 2024, gold peeled back. I can't remember exactly what it was at. I think it was between 2,500 and 3,000, and that's when we actually started buying and entering our position in that, and that has gone on this huge run, not without its volatility, of course, but I would say that's probably been kind of the biggest leader in this new market order.
Yeah, just with the increased uncertainty around the US and policy and Trump, I mean, more and more investors are piling into gold for a host of reasons. It's investors, institutional hedge funds, it's companies, it's central banks. It's really
Yeah.
this demand driven story where the more chaos that's created in the US, gold prices just keep pushing up. So we've actually had Agnico Eagles one we've had probably for a little bit longer than that, a couple years or so, which has been a big beneficiary. Then our physical gold positions, GLD, CGL, and then we've had XGD and Ring. So we've been adding to that over the last. It's been a while since we've added. We really haven't needed to add because the market's doing its work there. But we've got a good healthy position in there. And I think when you talk about winners and losers, and it's funny today actually because his Fed chair announcement, it's reversing that a little bit. And gold's peeling back, which is fine and probably healthy and normal because it was going out of control for a little while to the upside there. But you're just seeing this movement away from the U.S. dollar. We heard talk of that from Trump that they're okay with a weak U.S. dollar. I mean, I don't think U.S. dollar. Yes, headwinds. Yes, we're seeing it. Maybe not today, but weaken in general. It got down to its lowest level in 4 or 5 years. The Dixie. Does that mean though that we're not going to invest in U.S. equities? No, it doesn't mean that. And the reason why is, I mean, a lot of these companies, a weak U.S. dollar is going to be good for them, good for their bottom line. It helps exports. I think we're seeing that the U.S. is okay with a little bit of a weak dollar. Doesn't necessarily need that totally strong dollar posture where it needs to be the most expensive currency in the world. Lower rates as well will tie into that. Just when you then get a Fed chairman that potentially could be perceived as more hawkish, that's why okay. So lower rates, weaker dollar, that's good for gold. But I think what we've seen over the last year and a half or so in this new market reality, new market order, is that gold, precious metals, the whole commodities complex is a big winner. US dollars facing headwinds. So rather than saying like get out of US investments, don't invest in the US, what we've tried is gear portfolios a little bit more to commodities, precious metals, any hard assets too is another one of these themes. But that's one of those big kind of juxtapositions. And a funny thing too is people thought it was going to be Bitcoin was the new reserve currency, the new central bank currency, but we're kind of going old school. We're going old fashioned. It feels a little bit, I mean, I don't think we're there, but that the vibe we're getting is we're going back to the gold standard. So reversing and unwinding that. So it's interesting to watch. Very good for mining space and commodities, but that's probably the single biggest. And there's others. We'll talk about some others, winners and losers in this new market reality, but interesting times to say the least.
Yeah, and just one a quick point on gold before we move on is that through this last year and a half, we've seen some corrections with gold, 5-10% even, but the trend has remained strong, and it's not unexpected to see kind of pullbacks like what we've been seeing.
From a technical perspective, when gold's getting to those levels and getting extremely overbought, and I mean silver is another one that's making a lot of headlines. But you're seeing it run up like that. It's going to revert and pull back to a mean, but that doesn't mean that position's done. It normally means it's run too far, too fast, and it's going to go through a consolidation phase, basically meaning shorter term investors take some profits, longer term investors sit back, you get a bit of a drawdown, and then give it some time and you see a new phase begin. But interesting times for sure. And I think another area we could touch on a little bit, which is the other big theme, is in this new market reality. Let's call it as just the whole tech trade, artificial intelligence, because we're seeing some divergence there, some winners and losers for sure.
Well, it's interesting because technology for such a long time has all kind of moved together in the same way. Now what we're seeing is actually a little bit of a divergence within technology, more AI players versus non-AI players, and we're seeing that to start the year through the market.
Yeah, so I mean, what has worked well in tech and where the leadership is coming from are more, yes, AI, but I would say even more specifically some of the hardware infrastructure plays in AI. Like we've been pretty focused on the semiconductor area. Semis have been doing well because they just represent all the pipes and plumbing and everything that's needed to run AI, and it's heavily in demand, short supply. So you're seeing more and more money flow towards that. I think what you will see, and I mean this whole AI piece, we probably could do a whole video on it as well. But what we've seen is there's some companies that are kind of being punished. A lot of software companies, you're starting to see that. Tech companies that are at risk or potentially at risk of having their lunch eaten by artificial intelligence or just made irrelevant or obsolete. And so it's something I would say a trend to watch out for is not all tech is created equal. We're seeing some signs of weakness, certainly in tech, and some of these companies that are maybe not as essential to it or could get wiped out are at risk. And I mean, I think the other piece too is that yes, the AI bubble conversation, which we've talked about a lot, is still out there, and you've kind of seen tech in general, maybe the last few months, moving a little bit sideways. But that's a piece and a risk to watch out for too, for sure.
Yeah, so it's been kind of commodities, tech, and then the last piece, Will, just I want kind of get your comments on. It's just been the strategic resources, which have been a lot in the news. We've had exposure into our portfolio, but it's done really, really well to start the year.
Yeah, I mean, look, and that's not the only area, but you broaden out commodities, whether it's copper and base metals, but they're doing well. I mean, it's just really hard assets. I think in this uncertain world here, in this crazy world, a lot of hard assets are working well. So we've got positioning in base metals as well. A lot of these more old fashioned areas. I think the other area which we've touched on before is the whole aerospace, defense, security. Again, not necessarily the friendliest, warm and fuzzy area to talk about, but you're seeing that it's nationalization. Everybody's strengthening their borders. There's massive investment that's going into basically NATO and military. So why not own the companies that are going to benefit from that? And we see that whenever there's this uncertainty and craziness that's going on in the world, these defense companies start to pop. And so we've got international, European, North American, it's across the board, but they're big beneficiaries of the NATO spending and sphere. So that's really what you're seeing in this market, is that it's really a new reality. There's different pieces and parts of the markets working. I think the other thing that lends well to our strategy in this overall is that a lot of maybe the more just passive or set it and forget it, or buy and hold type approaches are not necessarily geared for this kind of chaotic and volatile environment.
Yeah, well, to that point, Will, like with one piece of news, one tweet, markets are moving, commodities are moving, the US dollar is moving. So, those passive buy and hold approaches aren't going to be able to be responsive in the way that, we are with our portfolio and our approach.
That's what we've seen. I mean, we've had certainly good numbers, strong numbers, good results, and I think it lends to the fact that we're geared on a more tactical, a technical approach, using a lot of ETFs as well. The thing that we've seen, even talking about winners and losers in this, is, I mean, one company or one area, like if you're in the wrong pocket and then you get a Trump Truth Social tweet. We saw that with United Health, and then this morning it's Bombardier. Your stock's down 20-30% just on the back of that, and it's borderline a command economy where the government started dictating which way things are going. So I mean, I believe our more tactical, technical base, the technical side just keeps us grounded in reality, because we're looking at where markets are actually going, what's actually happening, where things are moving, and how they're shifted. The ETFs help as well, that we're using in our portfolio, because they, number one, de-risk things. I mean, SOX Semiconductor is a good example, where meaningfully outperformed NVIDIA over the last year plus, and for the time that we've had it. So allows us to basically decrease some of the volatility, better diversify for investors, de-risk from some of these Trump social media, Trump attacks that are happening, but also allows us to fully participate in that area when things are going well. So I just think that in this new market reality, our approach, Aretec's approach, really lends well to that, and is really built to thrive in this sort of environment. And we've seen that play out in 2025, 2026, and for quite some time.
Yeah, and to your point, Will, we've had a good start to the year, in 2026. Portfolios are moving in the right direction. We've been making moves throughout the month and trying to position into the right areas. And to your point, by having a little bit more of an active approach, it's worked out for investors for a long time, but it's obviously good to see a good start in 2026 here.
Oh yeah, we're moving in the right direction, which is what we want to see. So as always, we want you to be wealthy. We want you, see your portfolio growing, making a lot of money, navigating these markets. We want you to feel wealthy. We want you, we don't want you to caught up in everything that's going on out there in the world, and we want you to realize your wealth. That's what we're all about. That's what Aretec Wealth is all about. So we'll be back with everybody next week. Stay warm and have a great weekend.
Have a great weekend.